In Search of Remedies for Nigeria's Economic Crisis by Paul A.B. Nigeria is in an extremely painful period of economic indisposition. Rarely does an economy suffer from all the known economic maladies to great depths of fatal incongruities as Africa's largest economy is afflicted right now. From low growth to high unemployment and an upsurge in the general price level to rapid fluctuations in the value of the naira and abysmally low productive capacity, these economic problems are compounded by a high and endemic multidimensional poverty index affecting 63% of the overall human resource. And last not least, the fantastic nature of corruption in high places, such as that involved special prayers being sent to mailboxes of national parliamentarians. Consequently, the mix of corrective measures to effectively deal with these assortment of economic challenges must be unconventional and in sharp contrast to prescriptions from neoclassical rulebooks or the Washington Consensus. Stagflation is the term economists have given to the combination of high inflation, low economic growth, and high unemployment as a single unpleasant economic reality confronting an economy. In other words, the economic crisis facing Nigeria is known by these cute-sounding words. As the term suggests, economic growth has been so low for so long that it is considered economic stagnation. Yet the economy is ravaged by high inflation. Either for its rarity or for its conflicting attributes as an economic ailment, there is hardly any universally agreed remedy to stagflation. Recession and inflation have stuck out as the two major economic problems defying eternal remedy to this day. Their combination, savvy economies consider the deadliest kind of economic challenge and practically work on staving off or guarding against. Recession, as a foremost source of economic insecurity, emanates from dwindling aggregate demand, which is the total spending in the economy. A fall in aggregate demand by implication is a fall in purchasing power. As purchasing power falls, producers cut down on production, which causes unemployment to rise. Basically, a recession is a fall in total output and a rise in unemployment resulting from falling purchasing power. To solve this economic situation requires increase in production, not for the sake of the goods that will be produced, but for the employment it will generate. It is from increased production that an economy is able to maintain an ideal standard of living. Economies use production to solve the economic problem of low or negative growth. Economically depressed times are times of insufficient economic activity resulting in low growth. In the competitive market system, this is an inherent feature. A period of expansion is succeeded by another of contraction. It is called the business cycle of boom and bust. The expansion is expected to be followed by rising prices, which eventually leads to contraction and falling prices in a never-ending cycle. In a depressed economy or time of contraction, firms are either going out of business or downsizing to stay afloat. As a consequence, unemployment increases and the months of the unemployed are deprived of the purchasing power. This results in a fall in aggregate demand. A fall in aggregate demand, which is the total spending in the economy, triggers massive cuts in investment, further compounding the contraction and attendant decline in prices. In this sort of situation, an appropriate measure to reflate the economy is to stimulate demand. Managers of the economy seek to address this economic situation of contraction with expansionary fiscal measures. They involve subtle manipulations of the tools of taxation and public spending at the disposal of the government. Because an economic slowdown or eventual or even an outright recession has its immediate cause in decline in aggregate demand or a fall in purchasing power, taxes are cut and public outlays are increased in order to stimulate aggregate demand and increase employment. However, this approach to solving the problem of low growth directly counters measures aimed at fighting inflation. To begin with, Inflation is the economic situation of an out-of-control increase in the money supply in an economy. Its effect is a rise in prices of goods and services. In fact, a time of rising inflation is a time of too much money chasing too few goods, because there's too much money in circulation. It is a time largely associated with a very strong economic growth. But there are also times high inflation is associated with structural changes in an economy. Inflation that is galloping hits the economically weak the hardest, since it erodes the purchasing power of the people. Conversely, an economy is booming. There is a surge in investments. People are actively engaged, and purchasing power is rising so much so that there is an excess of aggregate demand over supply. The productive capacity of the economy is stretched to the limits. As it does, something happens. The price increasing influences inherent to the system kick in, and steadily but unstoppably prices rise in the economy. And unless urgent measures are taken to forestall the trend, the resulting inflation becomes rampant. For an economy that elevates production to a place of prime importance, expanding the current productive capacity to absorb the excess demand becomes essential as demand overwhelms supply. Unfortunately, the inflation laying waste to Nigeria's economy does not come from strong growth or excess of aggregate demand over supply. In fact, the country has been struggling with a flagging economy for close to a decade now. Low growth and multidimensional poverty were the lot of large numbers of families long before the inflationary trend spiraled out of control, and purchasing power has been down ever since. From the foregoing, it can be inferred that the high inflation plaguing the economy is stemming largely from structural changes in the economy. It seems to me, therefore, that free floating exchange rate policy and the removal of petrol subsidy are the immediate causes of the high inflation. Nigerians are groaning under the heavy yoke of stagflation, so it is easy to lash out at the renewed hope federal administration of President Bola Tinubu. After all, the hasty missteps of petrol subsidy removal and floating exchange rate policy are major contributing factors to worsening the crisis. However, it is important that Nigerians appreciate the extent to which economic managers are racking their brains out to finding quick remedies to the current economic crisis. They are working hard to remedy two conflicting economic challenges in one fell swoop. Challenges each in itself alone can defy the best of measures at rectifying. Sadly, in a period of stagflation, the potency of these measures are constantly undermined one by the other. In all of this, the problem of low productive capacity fails to attract in-depth analysis. Yet it is the starting point of the country's economic woes. For too long a time, Nigeria had been untroubled about production. At best, the nations concerned with production had been half-hearted. But now that stagflation is wreaking havoc on the economy, maybe it will compel us to show some concern toward production. High inflation, low growth, and rapidly falling value of the naira have made proceeds from the sale of crude oil inadequate to getting our economic house in order. But all of these problems have their origins in inadequate production. The one question to ask then is, what measures do we adopt to increase the productive efficiency of the economy? Productive efficiency is efficiency in the use of the productive resources of labor and capital. Whatever the measures should aim at massive improvements in the quality of the human resource and committed investments in technological advances. Our big size is grossly inadequate if we are to place prime importance on production, because in the final analysis, size can only contribute to increase in total production, but not per capita production. Yet it is per capita production that directly influences living standards. Production, indeed, is the hallmark of a vibrant, healthy economy, a fact economic managers must recognize. Talking of the role of economic managers in relation to the myriad of measures to halting rising prices in the economy, it is always possible, though, with determined effort to fix prices in certain industries. One that readily comes to mind is the cement industry, because of its oligopolistic market structure. The industrialists, some of the foremost this country is justifiably proud of having, holding sway in this industry, role price makers, and the competition they have in this market is healthy rather than cutthroat. Given that it is an industry of administered prices, it is relatively easy to fix price that is collectively determined by industry and government. Recent media reports that price fixing happened in the industry because federal officials threatened lifting the industrial production placed upon the cement industry is empty hype. For an economy that has not deliberately cultivated robust business-government relationship, this kind of feat can be extremely difficult to pull off, and when it does, can be ascribed to something magical. It is expected of government officials to interface from time to time with industrialists and bankers to expand the possibilities of achieving these kinds of feats. An inflationary pressure caused by an expanding economy and excessive demand can be better tackled by fiscal policy, for the obvious reason that the policy will impact directly on the excess demand. Here, either the income tax can be used directly to absorb the excess purchasing power, or any kind of customs duties can be applied indirectly to reduce the demand. However, the use of fiscal policy such as an increase in tax to tackle the inflationary portion of stagflation leads to a reduction in the already weak purchasing power of the average consumer. Increase in taxes means cut in public spending, but since inflation is not the only economic challenge of the time, low growth is another. The conflicting measures cancel each other out. Fiscal policy directly affects consumer expenditure. Similarly, the use of fiscal policy to counter inflation undermines measures to boost production, since its target and reduced aggregate demand is a function of suppressed total output that is below the current productive capacity of the economy. Put differently, the policy is effective at arresting inflation or bringing about price stability only when substantial level of production and employment is sacrificed to bring demand into balance with supply. Happily, however, fiscal policy is not the only tool in the toolbox of economic managers. Monetary policy is another. A conventional monetary policy to curb inflation entails control of the overall price level. The mandate to conduct such monetary policy is the exclusive preserve of a central bank. Specifically, monetary stability is the mandate, though it is divided into price and exchange rates. To give further emphasis, I would like to return to the earlier definition of inflation. It is simply the increase in money supply, whereas the effect of such an increase is a rise in prices, which affects detrimentally the buying power of people. In monetary policy perspective, the excess money supply is equivalent to excess demand. At the disposal of the central bank to absorb this excess are such measures as open market operations and a hike in interest rates. In the case of open market operations, the bank sells bonds and gets paid in naira for the transaction, thereby reducing the money supply. As for the interest rate, it is a hike in the cost of credit for capital. Making the cost of capital expensive discourages further investments in the economy, with the hope of dampening excess demand eventually. The problem with the use of monetary policy to counter inflation is that it is a roundabout way to doing the task. Despite that inflation is excessive increase in money supply, the immediate effects of the condition is some unstable situation in which the force of demand outweighs that of supply. Yet monetary policy, instead of having its effect on demand, has it on investments. In fact, monetary policy reduces investment expenditure and therefore inimical to economic expansion. In a period of stagflation, monetary policy is rendered ineffectual. It does not tame inflation, and it is counterproductive to efforts at reflating the economy since it is stifling to investment drive in the economy. One reason it doesn't tame inflation is that the excess cost of capital makes investment capital inaccessible to businesses of the competitive portion of the economy. Meanwhile, industrialists, the big players of the oligopolistic part of the market, can either rely on retained earnings or source their capital from elsewhere. These producers, despite being affected, can always have a way of accessing capital to finance production, passing on the additional cost in form of high prices to consumers. It is my considered take from the foregoing that use of conventional policy makes to pulling the economy out of the depths of stagflation may not quickly yield the desired economic outcome. At best, we can only make do with a mediocre recovery. Having said that, I make bold to suggest that the part of monetary policy that is intended to discourage investment or slow down spending be suspended for the time being. Let the focus of monetary policy be on clamping down currency speculation responsible for the steady sliding away in the value of the naira. In other words, suspend use of monetary policy to curb rise in the general price level altogether within a time interval. But this is a highly controversial call. Fighting inflation is not just a mandate of central banks, it is a vested interest, and the Central Bank of Nigeria is no exception. Since capital markets do better with low inflation and slow growth, the central bank will always choose fighting inflation to tackling low growth. Clearly, it can be considered an intolerable meddling to ask monetary authorities to abandon the prestigious job of fighting inflation, and so may be unheeded. Ready to rally to the rescue as their Washington consensus backers, in addition to a rulebook they have sworn not to deviate from, and an independence they can assert all the way. If we, however, appreciate the peculiarity of our challenges, and importantly the fact that we are in a crisis, an economic crisis that festered over the years and has become intractable now, then the remedies we seek must not come from borrowed pages in the rulebook of the Washington Consensus. The best strategy, without a doubt, to wriggling the economy out of stagflation involves a subtle combination of fiscal policy and direct controls. This strategy intends firstly to factor slack into the economy. It is a slight reduction in the level of aggregate demands. Secondly, the fiscal stabilization measure of price and wage controls can be introduced mainly to serve as a spoke in the wheel of the interplay of prices and wages. That is to say, the price-wage spiral, often triggered by the situation of excess demand oversupply, can be checked by direct controls as soon as the excesses of aggregate demand are tamed. I would like to propose a policy of limited price control that can cover products from firms of the few oligopolistic industrial structures of the economy. Meanwhile, in the competitive market, staples such as rice and gari can be experimented upon, and only when the policy is successful should more food items be covered. It should accommodate measures such as that of Lagos State in establishing special markets in which low-income households can buy foodstuff at discount prices. These are food items heavily subsidized by governments. A policy advocacy of price controls can be as hugely controversial, if not unpopular, as pressuring monetary authorities to shelve fighting inflation. The price system is responsible for efficient resource allocation in the market economy. Replacing use of prices with direct controls in the task of resource allocation is always an unthinkable proposition. One vital observation we can draw from these painstaking analyses is that economic logic does not proceed in straight lines. Now we know why economics is logically too demanding and too frustrating. In fact, it takes an effort of will to propose a measure of wage and price controls in a seemingly free market system. The reason is obvious. Most economists have sought and achieved their reputation for being well-grounded in the discipline, but vigorously defending the free market system, but viciously attacking suggestions such as the fiscal measure of controls as socialism and therefore unacceptable. Price controls, despite being a difficult task, can be done if the administrators are top-notch microeconomists. It also requires a legal framework such as that Akwa Ibom state government is working on, and a relatively large bureaucracy. The legal framework can specify a mode of operation that ensures successes are accumulated in piecemeal. For an economy that wants very many things, such as maximum production, minimum unemployment, and price stability all at the same time, and given the conflicting nature of these economic desires, very little can be realized if measures have the distinct flavor of the Washington Consensus. Paul A.B. writing from Yenagoa, the Bayelsa State capital.